Welcome back, dear students and scholars. In video 1, we built the ASC 350 asset map. Now we move into Goodwill after acquisition. This is where ASC 805 hands the file to ASC 350, subtopic 20. ASC 805 explains how Goodwill is created at the acquisition date. Once Goodwill is on the books, ASC 350 controls the later accounting, carrying the Goodwill balance, testing it, and recognizing a loss when required. So today we are not calculating acquisition date goodwill. We are learning what happens after goodwill already exists. Our learning path today moves from the reporting unit to the journal entry. Goodwill impairment is not just a debit and credit, it is a judgment process first. We will cover the scope of ASC 350, subtopic 20, identify the reporting unit, understand annual and triggered testing, use the optional qualitative screen, perform the fair value test, record the journal entry, and finally look at private company alternatives. The memory hook is simple. Goodwill impairment starts with evidence and ends with accounting. ASC 350, subtopic 20, applies to goodwill after recognition. The most common case is goodwill arising from a business combination, where acquisition accounting is handled under ASC 805 and later testing comes under ASC 350. Internally developed goodwill costs are not capitalized. Goodwill embedded in an equity method investment is referenced here but tested under ASC 323, not under the normal goodwill impairment model. Fresh start reporting excess value also follows similar subsequent accounting ideas. The boundary is important. Initial goodwill calculation remains with ASC 805, subtopic 30. Under the general public entity model, goodwill is not routinely amortized. It is treated as having an indefinite useful life because there is no clear period over which the benefit is consumed. So there is no annual amortization schedule, and goodwill is not spread over years like a depreciation charge. A lighter way to remember it is this: goodwill is not peanut butter, so we do not spread it evenly across the years. Instead, we test it for impairment and write it down only when the facts require it. Once written down, that loss is not reversed later. The testing level is one of the most important points in goodwill impairment. Goodwill is not automatically tested at the whole company level, it is tested at the reporting unit level. The hierarchy starts with the entity, then operating segments, then reporting units, and then asset groups. Asset groups are important for long lived assets under ASC 360, but goodwill testing focuses on the reporting unit. A reporting unit is an operating segment or one level below an operating segment when it is a business with discrete financial information reviewed by management. ASC 280 helps identify the segment boundaries. Before testing goodwill, the company needs a supportable map. Assets used by the reporting unit are assigned to that unit. Related liabilities are assigned as well. Acquisition goodwill is also assigned to the appropriate reporting unit. Then the company can compare the fair value of that reporting unit with its carrying amount. If the map is wrong, the conclusion may be wrong. For example, putting goodwill in the wrong unit can create an impairment result that looks mathematical but is economically misleading. Good accounting starts with the right map. Goodwill testing has both a scheduled timing and an event based timing. The annual test is performed at a consistent date each year, and different reporting units may have different annual testing dates if applied consistently. But the annual test is only the minimum requirement. If a triggering event occurs between annual dates, the entity cannot simply wait for the next annual test. An interim test may be required. A predisposal test may also be needed when a reporting unit or a portion of it is being disposed of. Annual testing is the floor, not the ceiling. Triggering events are business facts that may force accounting action. A sharp market decline, a drop in revenue or margins, higher costs, the loss of a major customer, A strategic change, leadership changes, litigation, or regulatory pressure may all indicate that goodwill needs to be tested before the next annual date. No single factor automatically creates an impairment loss. Management must evaluate the total evidence. In practice, this is where accounting must listen carefully to the business because goodwill impairment often begins as an operating signal before it becomes a financial reporting conclusion. The journal entry is the last step, not the starting point. A disciplined close process begins with a business signal. Then, accounting and finance speak with management to understand the facts. Next, the accounting team documents the triggering event analysis in a memo. If needed, a valuation test is performed by comparing the reporting unit fair value with carrying amount. Only after the evidence and measurement support the conclusion is the impairment entry recorded. This is the professional workflow: signal, inquiry, memo, fair value test, and then journal entry. Goodwill impairment analysis is cross functional. The business head gives evidence about unit performance, customers, and operations. Finance planning or FP&A provides updated forecasts and budget explanations. Strategy may explain competitor pressure or market changes. Legal identifies litigation, regulatory actions, or contract changes. Tax confirms whether goodwill is tax deductible. Valuation specialists support fair value using market data, comparable transactions, or discounted cash flow analysis. Accounting gathers all of this, evaluates it, and retains it in the reporting file. Goodwill impairment is not an accounting team guessing exercise. ASC 350, subtopic 20, allows an optional qualitative assessment before the full quantitative test. This is often called the step 0 screen. The question is it more likely than not that the reporting unit fair value is less than its carrying amount? More likely than not means greater than 50% probability based on the weight of available evidence. If the answer is no, the company documents the conclusion and stops. If the answer is yes, the company proceeds to the quantitative impairment test. Inputs include market conditions, industry factors, cost pressure, unit performance, and entity specific events. When a quantitative test is required, the core comparison is straightforward. Compare the fair value of the reporting unit with its carrying amount. If fair value is higher, no impairment is recognized and the extra value is not recorded as a new asset. If carrying amount is higher, the impairment loss equals the excess of carrying amount over fair value, limited to the goodwill allocated to that reporting unit. So the formula is impairment loss equals carrying amount minus fair value subject to the goodwill ceiling. And once a goodwill impairment is recognized, it is not reversed in later periods. The order of testing can change the goodwill result. If the reporting unit contains long lived assets that may be impaired, those assets are reviewed first under their own guidance, such as ASC 360. If a write down is required, it is recognized before the goodwill test. Then the reporting unit carrying amount is updated, and only then is goodwill tested. This sequence matters because goodwill impairment uses the updated carrying amount. If other asset write downs are ignored, the reporting unit carrying amount may be overstated and the goodwill result may be distorted. Fair value evidence must follow market participant logic under ASC 820. For a reporting unit, fair value may be supported by quoted market evidence, comparable company data, discounted cash flows, taxable or non taxable sale assumptions, and internally consistent valuation inputs. Management optimism is not enough. Fair value is not the number we wish would avoid a difficult impairment charge. It must be derived from credible evidence. A good control point is this: fair value should never be reverse engineered to reach a comfortable answer. Accountants are allowed to be hopeful, but the valuation cannot be. Now let us apply the model. In 2027, Atlas Systems reviews Goodwill for its Cloud Analytics Reporting Unit, created from the 2026 acquisition of Pulse Cloud Analytics. The business has warning signs. Revenue forecasts have been reduced, customer churn is higher than expected, and a competitor has entered the market with aggressive pricing. The reporting unit has goodwill of $14 million and a carrying amount of $92 million. These facts indicate that management needs a fair value update for the reporting unit. The valuation team concludes that the fair value of the Cloud Analytics reporting unit is $84 million. The carrying amount is $92 million. The excess of carrying amount over fair value is $8 million. Goodwill allocated to the unit is $14 million, so the goodwill ceiling does not limit the result. Therefore, Atlas Systems recognizes an $8 million goodwill impairment loss. The reconciliation is clean. 92 million minus 84 million equals 8 million, and 8 million is less than the 14 million goodwill balance. Once the impairment loss is measured and supported, the journal entry is direct. Atlas Systems records debit impairment loss for $8 million and credit goodwill for $8 million. The entry is balanced and it reduces goodwill from $14 million to $6 million. The income statement shows an $8 million impairment loss in the period, generally as an operating expense. The balance sheet goodwill balance is permanently reduced. Future recovery is not recognized even if the reporting unit fair value improves later. Tax deductible goodwill can make the impairment measurement more complex. If goodwill has a tax basis that is being amortized for income tax purposes, the entity may have deferred tax effects connected to the goodwill balance. Recognizing a book impairment loss can change the deferred tax balance, and that may feed back into the carrying amount used in the impairment test. This is why the tax team should be involved early. The accounting memo should explain whether goodwill is tax deductible, how deferred taxes affect the measurement, and how the final impairment amount was derived. Not all goodwill follows the same path. If a reporting unit or part of a reporting unit is disposed of, the related goodwill may need to be included in the carrying amount used to calculate gain or loss on disposal. A pre-disposal impairment test may also be required. Equity method goodwill is different. Goodwill embedded in an equity method investment is not separated and tested under ASC 350 subtopic 20. Instead, the entire equity method investment is tested under ASC 323. The memory line is powerful. Identify the goodwill source before choosing the accounting model. Private companies and certain not for profit organizations may use accounting alternatives that simplify the goodwill model. These alternatives are elected, not automatic. Goodwill may be amortized on a straight line basis over 10 years or a shorter supportable useful life. If this alternative is elected, a mandatory annual impairment test is not required. Impairment testing is performed only when a triggering event indicates that fair value may be below carrying amount. Testing may also be performed at the entity level instead of the reporting unit level. But be careful. Public companies cannot elect this private company alternative. Here are the exam traps to avoid. Do not test goodwill at the total company level when the correct level is the reporting unit. Do not ignore triggering events by waiting for the annual date. Do not test goodwill before testing and writing down other long lived assets when required. Do not recognize a recovery of goodwill after a prior impairment loss. And do not apply the ASC 350 goodwill impairment model to equity method goodwill. Before writing your answer, identify the reporting unit, confirm timing, compute carrying amount, determine fair value, apply the goodwill limit, and verify the correct ASC path. That completes the goodwill impairment lesson under ASC 350, subtopic 20. We covered the post acquisition model, reporting units, evidence driven triggering event conclusions, qualitative and quantitative testing, impairment measurement, journal entries, tax cautions, disposal issues, equity method goodwill, and private company alternatives. In the next video, we move from goodwill to other intangible assets, including patents, technology assets, trade names, customer relationships, licenses, and defensive intangibles. Thank you for studying with me. If this lesson helped you, please like the video, subscribe to the channel, support the course, and share it with colleagues who want a clear US GAAP explanation.